given that 1 in 20 people live in a mobile home in America, and we have a crisis for affordable housing in the country. So it helps solve that problem for a giant chunk of American families.
That's a pretty shocking statistic.
You can't do a good deal with a bad person, and you're going to be able to tell if somebody's a little slippery when you're doing a deal in this space. I've seen people change their lives in 2 years on a hairy turnaround deal.
What lie do real estate investors often tell themselves?
That real estate is passive, that it is mailbox money as an operator, right? If you're going to own it yourself, you need to have systems in place. You need to have an engineering mindset. It's not that it's difficult or extremely hard. We're not rocket scientists here, but you do have to have an engineering mindset, operations, and systems in place to pull this off.
Brad Johnson joins me here today. You can find what his team is up to. Head over to vintage-funds.com. That, of course, is a clickable link in the show notes. We're going to be talking all things mobile home parks here tonight.
Well, thanks for having me on, Jack.
Is that you mentioned that your asset class has a bit of a stigma. Are you here to break those myths?
Sure. Yeah. I think the most people, when they hear mobile home park, they think trailer park. They think of that property that flies away when a tornado comes through town, right? So that's not what we do. We are in the manufactured housing community space, right? Where it's affordable housing. You are going to feel safe driving through it. It's not something that you would see in some horror TV show with some colorful characters. So yeah, and that stigma, that negative stigma, is actually part of the benefit of working in the asset class, is that you just have fewer players that either want to pursue the space or know how to, because they just had this negative connotation of the industry, which really is misguided, given that 1 in 20 people live in a mobile home in America, and we have a crisis for affordable housing in the country. So it helps solve that problem for a giant chunk of American families.
That's a pretty shocking statistic.
Yeah. Yeah, there's about 50,000 mobile home parks in the country. Maybe only 10,000 of those you'd want to invest in that kind of fit the criteria that I'm talking about. But yeah, there are a lot of them. And there's plenty more that just have their own parcel and they don't have a stick-built home. They have just a mobile home that they put on their own lot.
I've had a number of guests who've come on to talk about mobile home parks. Early on, it was still kind of a mom and pop operations. Is that still the case today, or
Yeah,
are you starting to see
surprisingly,
some consolidation?
we definitely are seeing consolidation, but I have been shocked at how long the consolidation is taking, right? I got in 2013 and thought that private equity would take a gobble up everything in 5 to 7 years. And they still haven't gotten everything, right? We're still investing in parks that are purchased from a mom and pop where either they developed it, their father developed it, and now they've decided they want to retire or realize, hey, what am I going to do with this mobile home park that dad built? We've held it for 30 years. We've gone through our depreciation. We have no way to shelter the income from a tax standpoint. And so we're ready to sell. It has been surprising at how long it's taken. Now, at the upper end of the asset class, where you're talking like a 300 pad park, the consolidation has happened faster at that scale, just because if you can imagine the Blackstones of the world, they don't want to buy a 50, 70, 100 pad park. They want to go as big as possible, put as much money to work. So there's an inefficient space in that 50 to 100 pad range that most of our properties tend to focus in that. Occasionally we get a great deal at 200 some pads that we find off market. But yeah, that's the inefficient space.
Hmm. So you mentioned the stigma associated with this. With that stigma, do you find that they're just not building any more of these, or towns and communities, because of the stigma, we're just not seeing any additional inventory?
Part of it is that cities feel like they can get higher tax revenue if they develop it into a retail center or go vertical with an apartment building versus a mobile home park, which is a fairly inefficient use of space, right? You can have pretty large lots. If you're going to get something that looks nice, you want to put maybe 5 homes on an acre. And so that takes up a lot of acreage. So generally speaking, that you're going to get more tax revenue as a city if you approve something else. And, once again, people's perception, if you say, hey, we're approving a new mobile home park in our city, the pitchforks come out, the not in my backyard people at City Hall, just because they don't know what an actual new mobile home park would look like. We've done one in Texas, which is one of the few states that you can actually get new parks approved. It's extremely difficult regardless, but Texas is one of the few states you can do it. And these look like subdivisions. These look like a normal community, stick built with really wide roads, concrete driveways. Some have garages for the home. So it's not what you would think when you'd hear the word mobile home park.
That could be part of the country that I live in, but more times than not, now in my world, when I hear somebody moving to it's usually snowbirds or retirement communities than anything
Sure.
else.
Yeah, there's a sliding scale, right? So a one-star park is that trailer park that, you're not going to want to invest in, or
Trailer park boys.
yeah, trailer park boys. And the other end of the spectrum is that five-star park, maybe a snowbird that's on the water in Florida. It's got bocce ball, it's got pickleball, it's got a rec center, right? So we're not playing in that space. That is you're getting that 8-9% return there, right? So that's more about what I would call a core deal that the large insurance companies or maybe sovereign wealth funds would like to own. We play in the 3-star space is kind of our sweet spot. I generally like when a 2.5-star park, which is just a little rougher on the edges, maybe with older homes. I love to come in and upgrade the housing stock and spend some money to improve the property. And then you make that a 3-star, you get a big bump in value that way. The lenders love that. So the asset becomes more liquid from a financing standpoint. And then you increase the pool of your buyers too, because the nicer the property gets, the more buyers are willing to look at it, including private equity.
Is that not the case with you?
When you say forced appreciation, do you mean through the strategy of operations?
Well, no, I would imagine that, in my part of the country, we just don't see people moving trailer houses themselves.
Oh, sure.
It just doesn't happen. So I guess a good forced appreciation would be in those vacant lots, new homes are being brought in to bring the neighborhood up, or paving the roads,
Sure.
or providing lights in some
Yeah.
sort of actual things to force an appreciation effort.
Yeah. So I think I call that operational alpha, right? So I think we are past the world of cap rate compression that's going to bail out your investment, where you're going to buy something at a 6 cap and then sell it at a 4 cap. I think now you have to focus on boots on the ground, get your hands dirty, have real teams and systems in place to move NOI, to move net operating income. And generally in our world, that is, yes, adding new capital to the property, repaving the roads, bringing in new homes to fill vacant pads, maybe expanding the park. So you're adding more income without having to just pass through a giant rent increase. Yes, the lot rents for the most part are too low at most of the properties in order for them to maintain being a mobile home park, and not having the tenant someday want to, go to City Hall and ask for some new regulation, which forces the owner of the park to sell. And then the new buyer comes in and levels the park. So the rents do need to keep up with inflation. That is true. But I think the days of just like buying the asset from 2,000 miles away, passing out a rent increase, and then selling in 2 years, that doesn't really work anymore. You need to be able to have a commitment to the park to reinvest capital into the properties, to improve it, to justify those rent increases. And plus, you don't really want to flip deals in this space. I've worked with large private equity groups in the space. They like the 3-year kind of hold because they're IRR driven. I'm more cash flow driven, long-term after tax cash flow, focused. And if you flip in 2 years, you're paying back the depreciation recapture quickly. And like I said, there's only 10,000 of these things that we want to own. And so if you finally get one under contract and you do all the heavy work to close it and turn it around, you generally don't want to sell it in 2 years because you have a very strong asset that's going to generate a fair amount of cash flow for a long time because of huge demand increase, right? With supply declining, or at least fixed.
Well, what's the low hanging fruit here? When you do get one of these, is there any efficiencies or physical changes you see are the trend regarding what typically needs to happen?
Yeah, the low hanging fruit is just a lot harder to find. If you completely find something off market and Pops has been just out to lunch, he has no idea the value of his property, yes, then maybe lot rents are 50 to 100% too low and you can increase them over time. And that's about all you need to do. Those are becoming fewer and far between. I think the low hanging fruit right now is more of in addition to the operational alpha that we talked about, I think that the real opportunity here is to buy something with seller financing because the debt is very hard today. So you buy something at 50% leverage, and so you over equitize it, and then you methodically improve it, and then you go and you refinance it with Fannie Mae by year 3 to 5. You pull out all your equity, and then you have a very high cash flowing asset that you can hold indefinitely risk free because you pulled out your equity at that point. That is the strategy that we're focused on. We love doing deals where we can, in theory, hold them forever. Ideally, the best ones you give to your grandchildren someday at a stepped up basis.
Hmm. So yeah, I feel like we're kind of going backwards here, but how did you find your way into mobile home parks?
No, I started with just single family, similar to you. We're just focused on single family homes. I didn't flip them. It was really more of a rental strategy. And this was just a side gig for my business. We were taking our profits from a consulting business and we were putting it into these real estate assets when I was 25. It was a lot of fun. It was just me and a couple buddies that we would buy a place in Nashville, in Scottsdale, in Palm Springs, in Austin, Texas. And then we would go and visit these locations and have a good time and then look at the asset and write off the trip, of course. So that was fun, but it wasn't a business. But that got my interest in real estate. And so I parlayed that into a more institutional position at a big private equity company and also a real estate investment bank. And when I was there, I would see these loan portfolios transact and I get into the data and see all these properties in these portfolios. And I'd see mobile home parks. And I noticed that they would have high debt yield. So in other words, the cash flow would be high. And yet they had the lowest default rate because the increasing demand, the fixed supply, the fact that the homes aren't technically mobile, they don't really move. So those factors led to something that jumped out that shouldn't exist, right? So that caught my eye, and that's when I left and threw away a bonus and left the bank and started my own company with a business partner and bought 23 parks across the country, 2,300 pads, and then sold that portfolio in 2020, and then have been investing in the space as a minority GP on behalf of our investors, our clients, for the last 5 years now.
Yeah, it's one of those things that the asset class that always has fascinated me because it seems like it's one of the few that you can actually have multiple cash flows coming at you at once. Like, because, a lot of the really successful mobile home park usually is also doing financing of these new homes that are being brought in, or there's always some other elements that people don't really realize is going on.
Yeah, you can get creative. So if there is vacant pads, generally it's faster for you to bring in a home yourself versus just waiting by the phone for somebody to move a home into your property. So generally, you're going to get a loan on that asset, that home. You're going to bring it in. You can act as the bank. You can carry the note, right? Some people like to just get it off the balance sheet as soon as possible, even sell it at a discount because then they got the lot rent, which increases the value of the park. So you could actually take a loss on the home and still make the math work. But yeah, there is creative ways to make ancillary revenue in this industry. The big REITs, they have a home sales divisions, they have financing arms. So they really take an institutional approach to those channels. But the nice thing about it is that you can do it 3 or 4 different ways. There's no like, this is the only way you can make money in this space.
So I would like, if you wouldn't mind spending a little time on any kind of tax benefits that you've seen, like in a traditional real estate, we have depreciation schedules and everything associated with that. Like, do you enjoy those type of benefits in a mobile home park?
Oh yeah, it's counterintuitive because most people think mobile home park and they hear land, right? Oh, you own the land, the tenants own the mobile homes, so you can't write off land, so there's not that many tax benefits. But actually, what you really own is the land improvements, right? So the land improvements, the roads, the driveways, the pipes, that's all 15-year property. So anything that's 20 or less property, you can bonus depreciate. You can accelerate it to year one. So that's a lot faster than waiting on commercial property for 39 years or residential for 27 years, right? So you get a cost segregation study, and generally speaking, we're going to bonus depreciate as much as we can year one. And now, this year it's 40% that you can bonus year one. It sure looks like the new tax bill is going back to 100%. So that should bring back these huge tax benefits, which often can add an extra 500 to 700 basis points on an IRR from an after-tax standpoint. If you just think about your ability to use that bonus depreciation to shield your taxes owed that year. Not everybody can do that. Maybe they don't have passive capital gains, or maybe they're not a real estate professional, but the people that can use those tax benefits, it's often a no-brainer, because sometimes you're putting in $1 for the investment and you're getting a $1 of paper losses that first year if 100% bonus depreciation comes back.
Could you spend a little time talking about let's say somebody is new to this, your due diligence process? How do you ascertain that this could be a good fit?
Well, I'll give you my best tip for somebody that's new and it's trying to get started in it. I would really try hard to find seller financing first, because to me, that is a giant shortcut on diligence, right? Because you have an owner, oftentimes pops, who's owned the thing for 30 years, believes in the asset, knows it cold, knows there's not going to, be anything that happens to it unless you're incredibly unlucky with some weather event. So he is putting a giant vote into the property. So he's probably not hiding something. And so the information that he gives you, you oftentimes can believe it. And you're rarely ever going to get perfect information on these parks, right? It's like, I've gotten shoe boxes full of receipts. I've gotten people who don't have leases. That's a pretty common one. And I've still purchased a park because the homes are there. That's an asset. And if you get a big enough discount, you have seller financing, and he actually pulled a fast one on you, well, then you stop paying the note and you work a deal out with him, right? So there's ways to protect yourself if you're dealing with the actual seller still as the lender versus a bank who's not going to be as forgiving, especially if it's CMBS, a Wall Street loan. They're not going to be forgiving at all. They're going to foreclose. So that's a shortcut for somebody that's new. And that's frankly how most deals with pops are getting done these days, because it's just very difficult to push leverage to that 75% level where it was in 2021. So you got to talk to experts and find the vendors in the space that know what they're doing and trusting them. Because frankly, I still don't know what I'm looking at when I see a sewer pipe or a water pipe, right? I want to be able to hire somebody that's legit, that has a reputation, that's seen it all, and they can give me a detailed report based on the systems. Driveways, asphalt, sure, I can figure out how, what shape those are in. But I was terrified in my first deal because I'm just like, there's so many moving parts with like the utilities and the electrical and all these things. But at the end of the day, it's pretty basic engineering, right? As long as you can get some of these vendors that have seen a lot of these parks, you're going to be in good shape. Really, where people get in trouble is getting scammed by somebody. They're fabricating rents by, they'll give you your bank statements, but they've been injecting their own capital into the bank to make it look like rents. There are ways to prevent that by just talking to the tenants and really asking for tax returns. It's kind of basic stuff, but yeah, I think my first point stands, like, try to get seller financing, and then, have a relationship with the guy. Like, I've done most of the deals when I was starting out that were small. I sat across the table at the guy's home and made a handshake on the deal and got to know him. And, I'm big on, you can't do a good deal with a bad person, and you're going to be able to tell if somebody's a little slippery when you're doing a deal in this space. And so just listen to those instincts.
You talking about relationships. Could you talk a little bit about the importance of the relationship you have with the community, like maybe even the city or the county that you're trying to operate in?
Yeah. Oftentimes we are a godsend because you're coming in with capital, and maybe Pops has not been reinvesting back into the property. So they're always going to be skeptical in the beginning because it's a new owner. Generally speaking, you want to do some sort of splashy capital improvement right off the bat. right? There's a new sheriff in town. We are going to reinvest in this property. We want to hold it long term. We're not trying to treat this thing like a cash cow day one and just double your rent. So as long as you're being more thoughtful about it, sure, just don't go crazy. Stay out of the papers, do it within reason, and then show that you're going to give them something for it. And then you often find that the community is thrilled that there's new ownership with new, fresh capital that has a long-term view. Like you can find properties where the community is actively like, hey, we'd all be better off if this thing went away, right? That's if something is a very hairy turnaround deal, which we tend to not do anymore just because, you can get an 18 IRR with less hassle than you can get a 20 IRR, right? So as I get older, I've realized that there's also a return on hassle adjusted IRR, right?
Mhm.
But you can make a killing if you are just looking for that one park in your neighborhood or county that is a disaster, and you come in with capital and it's blood, sweat, and tears and turn that thing around. I've seen people change their lives in 2 years on a hairy turnaround deal. I generally am not focused on that anymore.
When you're doing these acquisitions and trying to maybe turning properties around like that, since this is kind of an underserved class of
Yep.
residents, have you run into any state or federal programs that help with some of that?
There are occasionally, if you have a tenant that is ran into a rough spot, oftentimes there's local programs that will cover their rent for 6 months to a year. So we always encourage the property management teams that are local to get to know those organizations. Sometimes it's a religious organization, sometimes it's a federal program or a county program. And that is just so much easier versus having to pursue an eviction on a family that ran into some bad luck. So we'd much rather get involved with those programs and have somebody, get back on their feet, which oftentimes they do, right? A big chunk of the client base, the customer base is, they're great people, they're hardworking, but they just are living paycheck to paycheck. And a medical bill or a broken engine really just throws them completely off. And so all of a sudden, you can kind of see it in their credit reports where everything's fine and then boom, it tanks because of one surprise bill. And so if there are programs and ways that you can lengthen that for them, oftentimes they fix it. Or even better, they'll sell their home to a cousin or a family member or a neighbor who wants to get into the property and they built up a little equity. And so then it's not as complete a disaster. So we like to make sure people have some time to work those things out versus just like, here, get out, right? Because there is an asset there, right? There's something that it helps the security of the landlord to give them more of wiggle room versus apartments. I mean, you miss a payment, it's like those notices are gonna come like clockwork until they kick you out. Because it's always better if you can keep the people in their home because it's their home, it's not ours. And we don't want their home. We want them to maintain the home, keep the home. So yeah, you tend to want to work with people.
Yeah. I've only had experience with one mobile home park in my world, and it was a federal state program to underserve like low income housing.
Like a Section 8.
No, it wasn't a Section 8. It was actually like improvement. So we could have gotten like low interest
Wow.
funding to handle with like road improvements or some of the heavier things that we were struggling with otherwise. So there was just these programs that were available that I didn't even realize were available until after the fact.
Yeah, there are some states that have that. And I also like partnering with groups that we don't have a presence in that area because they will know those little quirky details about that
Yeah.
individual state or those programs where, from where we live, we can't always be smart on every market.
Yeah. So with all of that, I find it really interesting that you have these individuals now. You're going to take over this park. They likely have had a mom and pop operation up to this point. In fact, you even pointed out that in some cases you've been handed shoe boxes of receipts. So you're coming in relatively modern really right now. What kind of impact or shakeup have you witnessed with those existing residents?
Yeah, so there's oftentimes there'll be 3 to 5% of the tenant base that will just say, "Oh, you know what? Pops was a little bit easier and more casual about this. So I was breaking all these rules. I had, I had a bunch of stuff, a broken down car or something on my lot, or I would always pay 90 days late and he just, overlook it. Sometimes those tenants will just say, forget this. I'm going to go leave and go to the property, across town. But generally speaking, nobody really leaves for like a $50 lot increase. Especially if you're coming in and showing that, hey, look, we're going to reinvest back into this property. Yes, on a percentage basis, maybe on a $500 lot rent, a 10% lot increase feels significant. But once again, the absolute dollars are not huge. And so they do appreciate if you're giving them tenant statements now and they can see their balances. They like having a more professional manager. They like having a property management office. We generally will try to create one of those. They can call the customer service department if there's an issue with their bill. So there are professional things that maybe you and I are just used to when we become a customer of a business.
Mhm.
There's things that you just expect. Whereas with mom and pop, oftentimes they don't get any of that. It's just kind of, it's, hey, they pay them in cash sometimes. So
Mhm.
yeah, it does become more of a professional operation. They can submit queues for fixing their maintenance issue around their property. If we happen to own the home, they can do that as well. So yeah, it just becomes, there's more resources for them to use if it becomes a professional property management company that takes over.
So, Brad, this has been very interesting. Before we jump into the rapid fire and close out this episode, is there anything we should have hit on?
I think you covered most of it. I just like to repeat that we do have a housing crisis in this country, and they're not making too many more of these parks. And so I actually like investing in this space from that aspect to be able to decrease affordable housing and repair parks and bring them up to standards. I really think it's a net positive for the tenants there. And also, of course, our investors. There's some groups that only focus on the cash flow, make it short term. And we're not about that. We want to make sure that these things can last long term because we want to benefit from the cash flow long term. So anyways, that's my soapbox. Love the asset class. I've been investing in it for 12 years and hope to do so for the next 30 years.
Well, if you're ready, we'll jump into the rapid fire and close out this episode.
Let's do it.
What lie do real estate investors often tell themselves?
That real estate is passive, that it is mailbox money as an operator, right? If you're going to own it yourself, you need to have systems in place. You need to have an engineering mindset. It's not that it's difficult or extremely hard. We're not rocket scientists here, but you do have to have an engineering mindset, operations, and systems in place to pull this off. It's a lot of work. It's definitely not mailbox money if you are the operator or general partner.
If you could go back in time and give your younger self a piece of advice, what would it be?
I would just probably go bigger early. I wouldn't change too many things in my life. It's all worked out great, but I definitely could have made bigger swings in my late 20s, even early 30s than I did. It's hard when you're signing recourse on loans. You can get away with not having to do that now, but back in the day, you had to put your personal net worth anytime you got a loan from a bank. But I probably then, instead of doing that and kind of thinking, hey, we'll keep more ownership that way, I probably should have thought, hey, let's go partner with a big private equity group. I'll have a smaller piece of the pie, but the pie will be much bigger. So when you're younger, probably swing bigger because you have more time to recover if something goes horribly wrong, which it rarely does.
Do you have a book recommendation?
I'm a big fan of Charlie Munger's Almanac, Poor Charlie's Almanac. I read it every year around Christmas, and it's just a great book about not only investing, but just about life and about being a man. And I just think that we'd all be better off if we read it repeatedly. I'm a big believer in trying to read the same few books over and over again because we need reminding more than we need new information sometimes. And so I highly recommend it. You go out and get it. There's a new version of it that the guys from Stripe, the owners of Stripe, put together. It's really cool. And so I would suggest getting it if you're listening.
And finally, what single tool or process have you implemented that has had the biggest time-saving impact to you or your business?
Process or tool. Process it's not something fancy. It's not software. It's just an 80-20 mindset of just focusing on the 20% that's actually going to move the needle and delegating the stuff that is just maintaining the business. So I have struggled with that most of my life because I want to control things. I used to be a perfectionist. And the older I get, the more I realize that, you got to grow with people. You got to be able to delegate and focus on what you're excellent at. And that's the way to grow not only your business, but you as a person.
Just to remind everybody one last time, this was Brad Johnson. You can learn more at vintage-funds.com. I really appreciate your time, Brad. This was great.
Yeah. Thanks, Jack. I really appreciate having the conversation with you.